When the Dow Jones hits a new high, it's treated like a national achievement. Headlines cheer, politicians take a victory lap, and your retirement account might even look a little healthier. But the real economy often tells a different story. Wages can stagnate, small businesses can shut down, and millions can struggle to make ends meet, even on days the markets hit record highs. So, if the market is doing great, but people aren't, what exactly is going on? In this video, we'll unpack the myth that a rising stock market means a healthy economy. We'll break down the numbers, the narratives, and what they don't tell you, because sometimes the market is booming while the economy is breaking. We often hear people talk about the economy and the market like they're interchangeable, but they're not. They run on entirely different engines, and they measure completely different things. The economy is about what's happening on the ground. Are people working? Are wages rising? Can families afford groceries, rent, and gas? Economic health is measured using indicators like GDP growth, unemployment rates, inflation, consumer spending, and wage growth. The stock market, on the other hand, is a financial system, not a reflection of daily life. It tracks the price of publicly traded companies, based on what investors think those companies will be worth in the future. Key stock market indicators include things like index performance, the S&P 500, the Dow, the Nasdaq, price-to-earnings ratios, or how much investors are willing to pay for $1 of company earnings, market capitalization, essentially how much all shares of a company are worth combined, and volatility indexes like the VIX, which reflect how nervous investors are. So while the economy tells you what's happening, the market tells you what investors believe will happen. That's a huge difference. The market is forward-looking, often pricing in events that haven't happened yet. The economy is current-focused, rooted in real-world outcomes that affect most people today. And when the two start moving in opposite directions, that's where the confusion and the consequences begin. Let's make this real. Here are 4 moments in recent history where the stock market and the economy told very different stories. First up, the 2009 to 2021 bull market. After the 2008 financial crisis, the S&P 500 began one of the longest bull runs in U.S. history, tripling in value over a decade. But for millions of workers, it was a lost decade. Between 2009 and 2014, average real wages actually fell, and low-income workers saw the biggest declines. Janitors, cooks, some health aides, some saw wage drops up to 9%. While corporations reaped record profits, everyday Americans were stuck in a recovery that never reached them. Next, COVID-19 and the ultimate disconnect. In 2020, the U.S. economy ground to a halt. Unemployment spiked to nearly 15%. Food banks overflowed. Businesses shut down by the thousands. But the stock market? It soared. After a brief crash of March, the S&P 500 not only recovered, it ended the year up 24%. Why? Because tech companies, especially those benefiting from remote work, drove most of the gains. And massive government stimulus, combined with Federal Reserve support, pumped liquidity into financial markets. The result was what economists call a K-shaped recovery. Asset owners and high-income workers rebounded fast, while low-wage workers were left behind. Here's the data. The bottom 25% of earners faced a 39% job loss rate at the peak of the pandemic, compared to just 7% from the top 25%. Then there's the dot-com bubble, 1995 to 2000. During this period, the Nasdaq skyrocketed nearly 600%. Investors threw money at companies with no profits, no products, and often no plan, just a dot-com in the name. It was pure speculation. The economic fundamentals? In 1999, nearly 80% of tech IPOs had no earnings whatsoever. Market valuations were based on hype, not performance. When the bubble burst in 2000, the Nasdaq lost nearly 80% of its value. The broader economy had been growing steadily, but markets had flown far ahead of fundamentals and came crashing down hard. And finally, the 2008 financial crisis. In this case, the market led the downturn. Between 2007 and 2009, the S&P 500 dropped nearly 50%, even before the worst economic damage hit. But here's the twist. By the time unemployment peaked at 10% in late 2009, markets were already climbing again. The S&P had gained over 60% from its low, even while GDP growth remained sluggish and job creation stalled. These examples show a clear pattern. Markets and the economy may sometimes move together, but just as often, they drift apart. And when they do, it's usually not Wall Street that feels the pain first. We've seen the evidence. But what actually causes this ongoing separation between Wall Street and Main Street? Let's break it down. Because it's not just one thing, it's a combination of forces working together. One reason is that the stock market is always looking ahead. It doesn't reflect what's happening right now. It reflects what investors think will happen in the future. That's why stocks can climb even when the economy is in a recession, if investors believe a recovery is around the corner. Or why markets might fall during good times, if the outlook starts to darken. The Federal Reserve has even noted that markets often price in profits expected 5 or more years down the line. That's not exactly a reflection of today's paycheck or rent prices. It's a bet on tomorrow. Another factor is the role of central banks and monetary policy. Since 2008, the Federal Reserve has poured trillions of dollars into the financial system through a tool called quantitative easing, basically buying bonds to keep interest rates low. This pushes investors into riskier assets like stocks. It inflates asset prices, but doesn't necessarily create jobs or raise wages. In fact, research shows these programs can boost stock markets by 30 to 50% over 2 years, while having a minimal effect on the real economy. Then there's speculation, plain and simple. Markets aren't always rational. Investor psychology, hype, and herd behavior can drive prices far beyond any fundamental value. We've seen this with meme stocks, crypto booms, and the dot-com bubble. People pile in, prices surge, and then the crash comes. That's not a reflection of economic strength. It's a cycle of human emotion and momentum. Here's another key point. Most people don't own enough stock to benefit when markets rise. The top 10% of Americans own over 90% of all stocks. Meanwhile, the bottom half of households own less than 1%. Even though a majority of Americans technically have some money in the market, usually through retirement accounts, the real wealth is heavily concentrated. So when stocks go up, it mostly helps the wealthy. For everyone else, it barely moves the needle. And finally, the stock market just doesn't cover most of the economy. It tracks a few thousand publicly traded companies, but the US has over 33 million businesses. Small businesses alone employ nearly half of the American workforce, and they're mostly invisible in the market indices. Plus, many of the biggest companies in a stock market, like Apple or Microsoft, make a huge portion of their revenue overseas. Their stock price might rise even if the US economy is in a downturn. So when you put all of this together, forward-looking bets, central bank intervention, speculation, wealth concentration, and structural gaps, it becomes clear why the market and the economy often part ways. They're related, but they're far from the same thing. Let's put some numbers behind this disconnect. Start with GDP growth versus stock market returns. Over the last 30 years, US GDP has grown at about 2.5% annually after inflation. The stock market? The S&P 500 delivered nearly 6% annualized real returns over the same period, more than doubled the pace of the economy. Why the gap? Because the market doesn't just track the economy, it concentrates on the biggest, most profitable companies. Failing companies get removed from the index, and the winners, like big tech, keep gaining weight. Now look at unemployment and market performance. You'd think low unemployment equals strong markets, but the data shows the opposite. A major study found that stocks actually perform better when unemployment is high, as long as it's starting to improve. In fact, when unemployment is above average, markets have historically returned 12% annually, compared to just 6% when unemployment is low. It's all about expectations. Markets care more about the direction of change than the current snapshot. Even the wealth effect is smaller than you think. When stock portfolios go up, people might spend a little more. But on average, every $1 in stock gains leads to just 2.8 cents in extra spending each year. That's barely a ripple, especially considering most people don't hold much stock to begin with. The takeaway? The numbers don't lie. What moves the market isn't always what moves the country, and that gap is too big to ignore. When the stock market hits new highs, it's worth asking, what story is it really telling? Because while markets measure investor confidence, they don't capture whether wages are rising, whether people have stable jobs, or whether small businesses are surviving. When stocks soar while living standards stagnate, that's not a rising tide. It's a split reality. And if we keep using the market as a shorthand for economic health, we risk shaping policies that reward capital over labor and headlines that overlook most of the population. Real economic progress isn't about points on a chart. It's about people. It looks like broad-based wage growth, affordable living, strong small businesses, and an opportunity that reaches more than just the top. The market may predict the future, but it doesn't reflect the present, and it shouldn't be confused with the economy itself. Thanks for watching. Whether you're new to macro or deep in the data, this channel is about making sense of the bigger picture. I'll see you in the next one.